Imagine this. You walk into your bank, a place you trust, right? And they set you up with a meeting with their financial advisor. You think you're getting help planning for your future, your retirement, your family's security. But what if I told you that the person across the desk isn't really an advisor at all? In many cases, they're a salesperson with sales targets, pushing products that could be making the bank rich at your expense. Today, we're pulling back the curtain on the problem with your bank's financial advisor. But first, I'm Brad Lineberger, certified financial planner and founder of Seaside Wealth Management, helping you get more out of life with your money. If you'd like guidance on building a financial plan for retirement from a trusted fiduciary, use the link in the description below to book a free strategy call with one of our advisors. And now, let me show you why you should be careful about your bank's financial advisor. So what's the real problem here? It boils down to a massive hidden conflict of interest. The person with the financial advisor title is often the bank employee first and your advisor second. Their main job isn't always to give you the absolute best advice for your life. It's to sell the bank's financial products and services. Think about it. Every job has a metric for success. For a doctor, it's a healthy patient. But for many bank employees, success is measured in sales. They've got scorecards, targets, and quotas that they have to meet. And this creates a really high pressure sales culture. We meet with people all the time who've worked with their bank's advisors, and they often talk about the intense pressure. As an advisor for over 20 years, I've seen it all. And let me tell you, the intense pressure that bank employees are under to push products to meet these targets or risk losing their jobs is tremendous. They're not bad people, it's just a bad system. A system where the bank's profit priority is baked right into the advice you get. So how does this sales culture actually hit your wallet? It shows up as a product push. Banks make their own financial products, especially their own brands of mutual funds, which are often called proprietary products. And just like any company, they want to sell what they make. Advisors are often heavily incentivized, directly or indirectly, to recommend the bank's own funds, even if a lower cost or better performing option is out there. While regulators have rules against this, the pressure is still very real. It might come in the form of bigger payouts for selling in-house funds or just internal systems that make it way easier to sell their products over competitors. Some bank employees even have admitted they're encouraged to push the bank's products. The result? Your investment portfolio could be stuffed with the bank's funds, not because they're the best fit for you, but because they're the best fit for the bank's balance sheet. This funnels you into investments that primarily benefit the people who are selling them. So the other day, a prospective client comes in and I took a look at their portfolio, and they had half a dozen proprietary products, mutual funds, and the internal expense ratios were over 50% higher than the ETFs we're using in our portfolios. It was really expensive and it was coming right out of their pocket. This next part's really important, so listen up. It's the difference between a suitability standard and a fiduciary standard. Most bank advisors work under the suitability standard, and this just means that any investment they suggest has to be suitable for you. It doesn't have to be the best, the cheapest, or the smartest option. It just can't be obviously wrong. A fiduciary, on the other hand, is legally and ethically required to act in your absolute best interest. They have to put your best interest ahead of their own, period. Many fee-only financial planners are fiduciaries, but the title financial advisor doesn't automatically mean that someone's a fiduciary, and many at the large banks are not. They might be, but you have to ask. Even advisors with the CFP or Certified Financial Planner designation who are held to a fiduciary standard can face a serious conflict of interest when their duty to you clashes with their duty to their employer, the bank. This creates an illusion of expertise. You think you're getting advice from someone totally focused on your financial well-being, when in reality, they're really operating under a lower legal standard that allows them to sell you products that are more profitable for the bank. Okay, all this talk about standards and products might feel a little abstract. So what does it actually mean for your money? The answer is one of the most destructive forces in investing: high fees. The proprietary mutual funds that bank advisors are pushed to sell often come with high internal expense ratios. That's the annual fee that you pay, and it's taken on a percentage of your total investment. It's there, but it's hidden. And if you don't know where to look, it's literally gonna just eat away at the returns that really you should be getting. A typical bank mutual fund might have an expense ratio north of 2%. Meanwhile, you could get a low-cost index tracking ETF with a fee of 0.02% or even less. That difference sounds small, but over time, thanks to the power of compounding, it's catastrophic for your returns. Let's do some quick math. Say you invest $100,000 and the market returns an average of 7% per year before fees. With that low-cost ETF charging 0.2%, your net return is 6.8%. After 30 years, your $100,000 grows to about $737,000. Now, take that same $100,000 and the same 7% return, but this time in a bank's mutual fund with a 2% expense ratio, your net return is only 5%. And after 30 years, that only compounds to $432,000. Let that sink in for a moment. Really, let that sink in. The difference is over $300,000. Money that could have been yours. And that's the cost of high fees. You don't just lose the fee, you lose all the future growth that money would have made. A fee that looks tiny on paper can rob you of a huge piece of your retirement. That's the real world impact of conflicted advice. At this point, you might be feeling a little angry or worried. And that's a totally valid response. But the goal here isn't to scare you, it's to empower you. You have the power to take back control. And it all starts with asking a few simple but powerful questions. Think of this as your personal litmus test for any advisor. Here are the questions that you have to ask and get the answers in writing. Number 1, are you a fiduciary? This is the big one. A yes or no answer tells you everything you need to know. If they say yes, they're legally bound to act in your best interests. But if they say no, or they start talking in circles, this is a huge red flag. Number 2, how do you get paid? This uncovers their incentives. Is it a salary? Is it a commission on products? Is it a mix? Ask for a full breakdown. Specifically ask, do you get any extra commission or compensation for selling certain products over others? Number 3, what are my all-in costs? And don't let them just say the internal expense ratio. Ask about trading fees, administrative fees, and any other charges. You need to know the total, no surprise cost of your investments. Number 4, are you recommending the bank's own products? Ask them directly if the funds they're pushing are made by the bank. If they are, ask them to justify why they chose that fund over a potentially lower cost, better performing alternative from the wider market. An advisor who's truly on your side will answer these questions clearly and without hesitation. An advisor with conflicts of interest might get defensive or evasive. Their reaction will tell you all you need to know. So if you find out that your bank's advisor isn't a fiduciary and is pushing pricey products on you, what do you do? The alternative is to look for a fee-only fiduciary or a fee-based advisor. A fee-only advisor is paid directly by you, the client. They might charge a flat fee, an hourly rate, or a percentage of the assets that they manage, but they don't take any commissions or kickbacks from other companies for selling those products. This payment model gets rid of that central conflict of interest. Because you're the only one paying them, their only incentive is to give you the best advice possible. And finding one is easier than you might think. Organizations like the National Association of Personal Financial Advisors, or NAPFA, keep directories of fee-only fiduciary advisors that you could search. You can also search for independent advisory firms in your area that are built on a fee-only model. But here's the key. No matter who you talk to, you still have to verify their status yourself. Don't just assume based on a company's name. A simple search for fee-only fiduciary financial advisor near me is the perfect place to start. The first meeting is almost always free, so you have nothing to lose by exploring your options. Look, the relationship with the person guiding your finances is one of the most important that you'll ever have. It has to be built on trust, but that trust needs to be earned and verified. The system at many big banks simply isn't designed to put you first. It's designed to sell products. The advisors caught in that system are often just doing what they're told to meet their sales targets. But your financial future is way too important to be just a number on someone's sales report. You have to be your own best advocate. Ask the tough questions, demand transparency, and if you don't like the answers you get, now you know there's a much better way. The choice is yours, and retirement literally depends on it. As a firefighter for over 11 years, I understand the importance of trust and relationships and really preparing for the future. So if you have questions or concerns or simply want to partner in the journey, reach out to me and our advisory team will take great care of you. And also for another fantastic video, check this one out. I think you'll like it.